Hey everyone, and welcome back to Money Journey. Today we are diving deep into the Chinese stock market, where we have companies like Alibaba, JD, Baidu, and Pinduoduo. We'll be discussing the 2025 outlook for these stocks, exploring the broader Chinese economy, and analyzing valuations. Over the past few years, the Chinese economy has been on a roller coaster ride. At the moment, consumer sentiment is at 25-year lows. We have seen periods of rapid growth followed by significant slowdowns. Key factors influencing this volatility include the zero COVID policy, the stringent lockdowns and restrictions imposed to combating the pandemic, and the profound impact on the economic activity. Then we have regulatory crackdowns. The government increased scrutiny on tech companies led to heightened uncertainty and market volatility. And for the last, we have seen a real estate crisis. The slowdown in the real estate sector, which is a major driver of economic growth, has posed significant challenge. Despite these headwinds, there are reasons to be cautiously optimistic about the Chinese economy in 2025. We are seeing government support. The Chinese government has implemented various stimulus measures to support growth, including infrastructure investments and tax cuts. And then we have the tech sector recovery. The regulatory crackdown has eased and tech companies are poised to regain momentum. When we look to the share of global real GDP, China has grown a lot in the last 50 years, and it is expected for the Chinese real GDP to continue to increase and take market share in the world. So right now we are close to 20%, and the Chinese economy it will be continued to grow. Then we have global earnings estimate. Chinese economy is being in the slowdown, but right now we are seeing an inflection point. We are seeing the earnings of the Chinese assets to start to increasing again, so we might see some consumer confidence to start to increase as well. And when we look to expectation for global growth, only if you exclude India, we are expecting the bigger growth to be on China. It will be higher than in the US, on Japan, on Eurozone, even on the UK. So China is expected to grow 5%, between 4 and 5, which is really good for an economy of the size of the Chinese economy. One of the most attractive aspects of Chinese stocks right now is their valuation. Compared to their US counterparts, many Chinese stocks are trading at a significantly lower valuation. This is primarily due to the regulatory headwinds and geopolitical tensions. However, as these concerns subside, we could see a significant reevaluation of Chinese assets. Bear in mind, we are seeing a big discrepancy in valuation in China, in Europe, in the UK, in Japan, when you compare to the US. But this is a little bit misleading. When you compare to Europe, in Europe, most of their assets are on financials, industrials, and these companies usually trade at lower valuation because there are a lot of debt. Their growth is not very high, and their margins are not so big when we compare to tech companies. And a big percentage of the US market is tech right now. So there are US market should be trading at a higher valuation, and because of their that is where we see the best companies in the world. Of course, we have to pay a premium. So if you compare only the financial industrial companies in the US to the Europe stock market, there will not be a big discrepancy. So I do not think Europe is so undervalued. Actually, it will be around fair value when you compare the quality of the companies and the growth expected in Europe. But in China is different. In China we are seeing bigger growth than in the US. We have plenty of tech companies. They are a leader on industrials, for example. So the only risk I see on China is the economic risk, government. But when you compare to the companies, we see really great high quality companies on China. So this discrepancy should be so high. That's why why we believe that is a big opportunity on China. Then we look at the median valuation for China, the 25 million, we are trading under the mean. Even when you compare the 25-year range, we are trading at the lower bottom. So this is signs that Chinese assets are really undervalued. So what can we expect from the Chinese stocks in the future? While it's impossible to predict with certainty, there are some key factors to consider. Economic recovery. A strong economic recovery will be a major driver of stock market performance. Regulatory environment. A stable and predictable regulatory environment will boost investor confidence. And geopolitical risk. Geopolitical tensions, particularly between the US and China, could impact market sentiment. When you look to the JP Morgan asset return expectation, the bigger expected returns are on China and Eurozone large cap and in Japan. I believe JP Morgan believes that because of a lot of factors. Lower consumer sentiment right now, but they are expected to recover. There are market cycles, a return to the mean. Valuations are really low on China and Japan, for example, as well. And there are plenty of growth expected for China in the next few years. That's why, based on JP Morgan research, that the assets that they are expected bigger returns are on China, even for a big bank on the US. Investing in Chinese stocks can be a high risk, high reward proposition, and it's all about that. It's important to conduct a thorough research and consider the risks involved. A diversified approach, including investing in a mix of Chinese stocks and other asset classes, can help to mitigate the risk. In conclusion, the 2025 outlook for Chinese stocks is a complex and multi-faced. While there are significant challenges to overcome, the long-term potential of Chinese economy and its tech sector remains strong. By carefully analyzing the factors driving the market and adopting a disciplined investment approach, investors can capitalize on opportunities presented by Chinese stock. So that's our analysis on the Chinese stock market for 2025. I hope you liked, and please like and subscribe. See you next time.